This one change meant that they could buy $1 million worth of property with just $1,000 a year income.
I was shocked they could borrow $1 million earning that much.
I think the days of building a large property portfolio are over because of so many interest rate rises, not to mention the cost of living increase.
Australians were hit with the biggest increase.
And we'll be praying that the Reserve Bank does not hike rates again.
In today's economy, what is the best way to get your hands on
$1 million?
Together with mortgage broker and developer John Kef, we outline why you don't need to be a supervillain to get $1 million in 2024.
Making these small changes now have the opportunity to make you millions over the portfolio lifetime. Same situation, the lowest was around $650,000 and the highest was $923,000.
Wow.
3 different scenarios, all unpacking exactly what they'd need to do to get approved for $1 million loan.
$83,000 income, which is achievable for a lot of people.
But remember, this is not financial advice. Even if your situation is similar to one of our scenarios, you must seek independent professional financial advice. My name's Todd Sloan. This is the Pizza and Property Podcast. And if you've been enjoying the content we're making, we would love it if you subscribe before the video starts. But right now, let's get into my chat with John Kef.
John Kef, how you going, mate?
Good, Todd. How you going?
Mate, good. This is going to be an absolute cracker. I've been wanting to make this episode for a while now. And it's, I want to say under a lot of requests, but it's come in from requests from all these different angles of how much can I borrow? What kind of things can I change to have more? And so having these 3 scenarios in front of us, all kind of with a similar thread through them, I think is going to help a lot of people, mate. Is there anything you kind of wanted to set the stage with before I get into disclaimer city and start opening up all the scenario?
Thanks, Todd. I just want to make note that when we are looking at different scenarios, we are looking at these scenarios today. So in 2 years' time, things could change, rates would drop, banks' policies would change. So what we're talking about today could be different in even 6 months' time. So, and every bank is different, and every bank does change their policy. So it's important to really assess your situation at the time and not rely on this information for 2 years' time because things do change.
I've always known banks are different, and it's one of the reasons I've always used brokers. But doing this opened up my eyes so much to, it's not just a bit of difference. It's not just one will give you 560 and one will give you 580. Some of them were literally like hundreds of thousands of dollars difference.
Correct. Yeah, it's amazing how just a simple change in your situation can really change how much you can borrow. So it's understanding how banks work and how every bank is different.
Massively. And I feel like I have to say, obviously, none of this is financial advice. Please seek independent professional financial advice from a qualified professional. This situation is not your own. You need to do this with a broker. And it's actually one of the things that kind of pushed me towards doing this, because when I very first started investing in property, I remember I'd go around. I just happened to be very good friends with my broker at the time. And I'd bring around a 6-pack and we'd play with the servicing calculator together. And it was so much fun. I enjoyed it. It's probably not how most of people want to spend a Friday night. I'd probably not even how he wanted to spend it, but we did it. And I tell people to do this all the time. And I just don't feel like many people do. There are very few. Sometimes people come back and go, I did it and it was amazing. But this episode is really designed to give you 3 different scenarios on exactly that. You don't have to bring around a 6-pack, but sitting down with a broker to actually really go through what are my options is such a powerful tool as a property investor. And this is one of the very first steps I believe everyone should be doing.
And I actually love doing Zoom calls with clients and actually sharing my screen to actually show them the calculations on how banks work and how they are all very different too. So
perfect.
Showing clients how things work helps them become educated and learn about the process as well.
So if we can have our scenario kind of explained a little bit, we're looking at an 88% lend, and the purpose of this is to borrow $1 million. 88% LMI, 88% plus LMI,
yep.
And we're looking at in Queensland. Now we just had to choose somewhere. Just in case anyone's wondering why Queensland, there was no real kind of reason behind it. It was just looking at some of these yields that we've gone for. Queensland, you can probably hit the nail on the head with all of them. Whereas you're probably not the same way in New South Wales, maybe not even South Australia in some points, but you're definitely doing it in Queensland.
Yep.
Okay. Is there anything else you want to say about the scenarios before we get into the first one? Or should we just jump in?
Just jump in. We just made the assumption of the yield at around...
So this first one is 5%.
5%. Yep. So quite achievable. $1 million purchase, 5% yield.
And just in case if anyone's thinking you're not buying a house for $1 million and renting it out at 5% yield, correct. But you could buy 2 duplexes. You could buy a block of units. You could buy, there's plenty of other different options that you could get a 5% yield on, especially in Queensland.
I suppose, well, the other part of the scenario is we've assumed, in order to purchase a property for $1 million, the deposit that you will require is about $165,000.
165. Okay.
Yep. So about $165,000 deposit,
Mm-hmm.
$1 million purchase. Let's start off with the first scenario being that you're renting somewhere else, paying $500 per week.
Okay, so renting, paying $500 a week. And now this first person is self-employed, correct?
Correct. Yep.
Okay, so self-employed, and this is something that we'll go into in a second as well. I purposely wanted to have this in here because I get people messaging in saying, I'd love to be able to invest, but I just can't because I'm self-employed. A few different variations you ran on this didn't really show a huge difference.
Not really, no. So generally, self-employed people claim a lot more of their expenses through their business. So that's where sometimes their income might be lower than someone that's just PAYG. So it doesn't make much difference if you are self-employed or PAYG, but if your income is, call it, in this situation, what we worked out is that you need to be earning $140,000 a year to borrow the amount required, which is around $900,000. So not to purchase a property for about $1 million.
Yep.
Your income needed to be $140,000, and that's self-employed, but also PAYG as well.
Okay, so if I've understood you right, the difference isn't actually the income coming from PAYG or a small business. The difference is if you try and write off a huge amount in tax, because then the bank looks at it and goes, well, you just said you only earn 40 grand a year. Of course, we're not going to give you money.
Yep. And a big one is depreciation. So you might have bought a car and be depreciating your car through your business.
Yeah.
Some banks add back 100% depreciation. Some banks only add back 20% of your net profit as depreciation. So there's different variances as to what you can add back being self-employed. So again, the importance of seeing a finance broker who understands self-employed applicants, knowing what you can do and how to get the figures right to work out what you can borrow.
And I feel like this is where a lot of people get a bit like disenchanted because they'll maybe sit down with one bank or sit down with a broker that doesn't actually really understand the differences when it comes to PAYG and small business. And maybe they're compared to a lender that has 20% instead of the 100% with like depreciation. And I'm sure that's only one variable that's on the plate of many.
Yep.
So being able to actually look at the whole spread is going to make a huge difference.
Another example is, let's say you've got a company and you've got a loan for a motor vehicle. Say you're a trade and you've got a ute. Most banks would actually include that liability in your servicing. There's a few banks that you can go to that they'll look at the net profit of your business and exclude that liability because that liability has been covered by your business. But then your borrowing capacity is actually higher with some banks than it is other banks because that liability has been excluded. So there's little things like that make a huge difference as to how much you can borrow, even if you are self-employed.
So Tom the tradie here, we've also assumed that he's got a pretty clean credit history. He doesn't have like what's called like credit cards. He doesn't have HEX debt, anything along those lines.
Yep. So quite simple, no liabilities.
Yep.
In option one is living in a rental property, paying $500 per week.
Now, how does that change if Tom goes, you know what, I'm going into full sacrifice mode. I'm going to either rent a room from a mate, I'm going to live with mum and dad.
And so instead of paying rent, you're going to be boarding pretty much. So if you're boarding instead of paying rent, let's say you're paying rent of $500 a week as opposed to boarding, where you might be paying $100 a week for a room.
Yeah, staying at a mate's place, giving them some cash, that kind of thing.
Correct, yep. That would reduce your monthly commitments, obviously. So by reducing your monthly commitments on what you're spending would increase how much you can borrow. So under that same scenario, if you were borrowing $900,000, buying property for $1 million with a 5% yield, if you're renting, your income needs to be $140,000. If you're boarding, your income drops by $40,000 as to what you need to be able to borrow the same amount of money. So $100,000 a year as opposed to $140,000 a year if you're boarding to buy an investment property on that situation.
Okay. So the first thing I think of is how long do I need to board for? Because I can't help but think that there might be a few people listening going, yeah, I can do that for like 6 months or a year, but I'm not doing that for 10 years. Like, how does that work on the time frame?
Well, at the time of applying for the loan, if you're not paying rent and you're boarding, and you can prove that you're boarding and you're living at that address and your ID reflects that address as well, you can pretty much do it within a few weeks of moving to that property because your situation at the time of that application is that you're not paying rent and you're boarding.
Okay, so for anyone that's thinking, well, what happens when I stop boarding? It's not like the bank knocks on the door and says, well, hold on a second, go back to boarding or we'll sell your house.
They don't know. And your situation could change as well. So in a year's time, your income might have gone up $10,000 or you might have a new partner with income. So your situation changes And you might decide then to move into that property later on. So if as your situation changes and you can afford to move in instead of rent it out, you can decide to do that at a later date.
It's just such a difference. I look at this and I think that there's two things. Like one, I've done it, you've done it. We've both been down this path before of living with the parents and going into full sacrifice mode. Yep. But I also think then there's the other level of it going, okay, what if you actually were on like 140 a year? Obviously you're going to need a higher deposit, but then your borrowing capacity, if you were to then board with a mate, live at home, is then jumping pretty significantly from 900 to then it's going into what, the 1.2s, 1.1s, like it's huge.
You probably would, Todd. I haven't worked out that scenario, but it would jump up a fair bit. And subject to your deposit,
yep,
you could then buy a property that's more expensive or buy more property. Or in a year's time, you might have a higher yield on that property. You might have had some equity. You might have added some value to that property by renovating it.
Mm-hmm.
Access your equity and buy another property. Again, living with boarding or living with parents, and your borrowing capacity will be a lot higher by doing that.
Our final scenario, scenario 3, which we'll give them some names in a second. That's the one that probably blew me away the most. And I think a lot of younger people are going to get more from as well. But scenario 2, we've got someone that's going, all right, I'm going to chase more of a yield play. All right, tell us more about the scenario 2. What are all the details there?
The scenario 2 is still purchasing $1 million worth of properties, but breaking this up into 3 separate properties like you've just said. So
and still the 88% with LMI?
88% yep. LMI. So we've got 3 properties, 330, 330 and 340, but at a higher yield. So we're chasing a yield of 7.5% in this scenario.
Which, for anyone wondering, why does that matter? Why does it?
The higher the yield, the more you can borrow, or the less your income needs to be to borrow that money. So the scenario we've got here is a higher yield in order to be able to show that your income needs to be less to be able to buy these properties.
Okay. So as much as this one's PAYG, like this person, actually, what do you want to call this person?
Bob the builder.
Bob the builder. Okay. So I got Tom the trading Bob. We are so creative with names. All right. Bob the builder. So Bob the builder, what's he earning?
120,000.
120,000 a year.
Yep.
Okay. So and he's buying with 7.5%. So that's a 20K difference. What is that predominantly because of the yield?
Because of the yield. Yep.
Because of the yield. Yeah, right. Okay. So 20K difference. So as far as self-employed and PAYG, you're saying that's not really coming into it, right?
It's got to do with what your net income is. Because you pay the same amount of tax whether you're earning $140,000 net self-employed or $140,000 net or $140,000 gross, I suppose, that's PAYG before tax. So both before tax.
Okay. So both before tax. So they're both gross. One's gross 140, one's gross 120.
Correct.
Okay.
Yep.
I feel like you're really dispelling the whole the self-employed, it's too hard. It really does just come down to what are you showing the tax man?
Correct. But there are other variables like we said before. So self-employed, you need history there.
Yep.
There's other factors that you might claim things through your business which you can't claim if you're PAYG, which then reduces your income. So there's other variables like that which come into consideration when you're self-employed. So basically scenario is renting, paying $500 a week.
And what about the deposit? Is that still the same, 165?
Slightly less because we're split it up over 3 properties. Stamp duty is slightly less, so it's at 162.
Okay, so
not much difference.
Not much difference, but still a little bit different. So we're saving $3,000 there.
So that scenario basically is income required of around 120 to buy 3 properties totaling $1 million with a yield of 7.5%.
And now, what happens if Bob decides to again board, move in with family, whatever they want to do, to really lower that hem?
Yep. So this actually surprised me a lot as well.
Yeah.
So reducing the cost of rent, your income required to be able to borrow that same amount would reduce to $83,000.
83. Okay. So if someone's listening to this right now thinking, I'm on 83 grand a year.
Yep.
And I can borrow $1 million potentially.
Correct. Or you can buy $1 million worth of properties.
Yep.
Based on having a deposit of around that 160 mark, $83,000 income, which is achievable for a lot of people.
Yeah.
They could potentially, if they want to make that sacrifice, living at home with their parents and save hard, they could potentially buy 3 properties worth about $1 million.
I met an Uber driver the other day that told me he earned 90 grand a year.
Yep. So
I didn't, yeah.
That's pretty good.
Okay. So $83,000 a year, but yeah, you're having to board or you're living with parents.
Yep.
Okay.
Yep. So there's, as you can see, there's a huge difference there between renting somewhere and living with your parents. And it comes back down to your expenses. So obviously if you're paying $500 a week, it's 26 grand a year, that's $26,000 of net income you need to be able to pay your rent.
Gotcha. Okay, and then yeah, actually I didn't even think of that. So $40,000 a year difference, 35% tax bracket. That is 26 grand, isn't it?
Yeah, it is about the same figure. Yeah.
That doesn't sound good when you think of it that way. That's
So
a lot
you
going to the government.
You need to be earning 40 grand a year to pretty much cover your rent.
Talk to me about the income side of things from the rental properties, because I'm looking down here at like $1,440 a week rent versus $950 a week. So we're talking about our difference in rent, $950 per week for our 5% yield for Tom. But then Bob's going high yield. He's smashing through Rockhampton, Townsville, whatever he's doing. And he's getting $1,440 a week rent. So it's, what is that? Like an extra $500 a week pretty much in rent. So that is another huge contributing factor, though, isn't it?
Correct. I might just add something in here as well, Todd. So he might buy the first property at a 5% yield, add value to it, and then be up to 7-8% yield. So, and then buy the second one, but you've got the first one already at 7-8% yield. So that's the way you could look at it as well. So the first one that you're buying is at a lower yield, but adding value to it, like Bob the Builder is renovating it, new kitchen, new floors, getting a higher rent, his yields are better.
The question really is, can he fix it though?
Yeah.
But what about if the property's under rented? Because right now I'm thinking about like if someone's seeing something that, I don't know, it's rented out for $300 a week, they're looking at it going, surely that's worth $450. Like I know I had that situation on the block of units that I purchased. This was late 22. To me, it was grossly under rented. I was looking at this thing thinking it was like $1,000 a week or something. It was $760 or $770. Now we're in lease negotiations with a couple more, but it's about to be, I think, about $1,450, $1,500 almost per week. Yep. How does it work with the whole rental letter thing and saying, here, Mr. Bankman, this is what it should be rented for?
If the property is rented, it's actually going to be on the contract. So it's going to say what rent that property is actually getting, and the bank will then use that figure. But if the property is vacant and you're buying the property as a vacant possession, you can then get a rental appraisal from a real estate agent to say what the rent will be on that property, and the banks would generally use that figure.
So even if the property is like grossly under rented, the bank will go, doesn't matter, that's what the rent is.
Correct.
Interesting. So you're actually better off in that case getting a vacant property.
Yeah.
Because that's gonna dictate your lending.
Yep.
Yeah. Wow. Okay.
Yep. Because it will be on the contract when you're buying a property that it's leased out, and it's leased out for X, and the banks basically just have to use that figure that it's being rented out for, because that's the actual figure that you're actually getting rent.
All right, I'm going to throw you a curly one here, and tell me if you can answer this. It's fine if you can't, because I might just be making things tricky. You know how you can do an as complete valuation? Very rare, but you can do it. And I'm also very rare with a renovation. I've never done one, and I've been told about a few people doing them. Can you do like an as complete, this is what it will rent for once we've got everything renovated?
Not on a purchase, unless you've got a building contract in place to say, generally not on a purchase, no.
Okay. So if you had a building contract, possibly, but that's not really a done thing that you say.
Yeah, not really done, no.
Yeah.
I've actually never done it before, but I'm just trying to think out loud here. So if you had it's like you're buying land with a building contract. So theoretically, you could do it and borrow on completion figure.
Okay.
So you probably could do it, yeah. So if you bought a property and you wanted to do it, but you'll need to have all your council approvals in place, your building contract in place, all your selections in place before you actually even settle. So which is not likely anyway.
So if you're looking at chucking 30 to 50 grand at a DIY reno, that's not doing anything for you.
No.
Yeah, gotcha. All right. I'm curious on that one. I always like to think of what's the outside the box.
So you could borrow that extra money, obviously, and not use your own cash.
Pretty much, yeah. But so as far as Bob's concerned, 120 grand a year, it can drop to 83 if he's willing to go into sacrifice mode, board a room, live with mum and dad, whatever it is. 162,000 in capital, and he's needing to buy at a 7.5% yield, so big yield.
Yep.
Is there anything else that you want to talk about with Bob's situation before we name our subject number 3?
Well, the thing is, he probably won't go buy 3 properties all at the same time. Mm-hmm. So if he buys his first property and he can add value to it and get a better yield, and then again the second one, add value to it and get a better yield.
Good point.
When it comes time to borrow, and also maybe potentially get some equity out of it. Mm-hmm. Probably not, because we're already borrowing 90% anyway. So I don't think you're going to get more than a 10% uplift anyway.
He'd want to be pretty good at renos.
Yeah, it's possible. Yeah. But assuming that he's getting a better yield on that third property, that third property might not have to be a 7.5% yield because you've got an increase in the yields in the other one.
I see what you mean.
So, yeah, I think if you can buy whatever you buy, try to add value to it. So if you can buy a property, add value to it, renovating it and renting it out, you're obviously going to be you're adding value to it. You're increasing your rent as well. So if he's in a position where he can do that and he's a builder and he's handy and that's what he's good at, I'll definitely be trying to do that where possible and buying a property that suits that type of that market.
Well, and whilst it's not the renovation side, that's what you built your whole portfolio on. It's adding value.
Correct. Yep.
But
So
you did it more on the development side.
correct. Yeah. So buying blocks of land or buying a house on a larger block and subdividing it to 3 to 5 to 20 houses and building houses. Yep.
How big's the one you're doing now?
The one I'm doing now is a large land division, which is the largest property I've ever done, which is about 130.
130 blocks of land.
130 blocks of land.
So from 1 into 130.
Yep.
Yeah, that's pretty big, John.
It's taken 4 years to get to where we are today, though, but it's
Like, not you've been investing for 4 years. Like, that's a 4-year project.
since we first bought it. Yep.
Yeah,
We
right.
bought it 4 years ago. It was industrial site, rezoned to residential, and now we're ready to go ahead.
Just in case you're wondering why I've changed the subject to John's portfolio now, I kind of did this on purpose because, again, you lived with your mother-in-law for a few years.
Yep.
You went into full sacrifice mode. If there's anyone listening thinking, is it worth it? 1 into 130. I'm not even going to go into the profit margins you've got on that because you've told me a little bit about it. It sounds like it's an amazing deal if you pull all this together, and it's sounding like you're going to pull it all together. I say that because I look at the short-term sacrifice. If you do this correctly in property, that's proper life-changing stuff. Like, it's worth going into sacrifice. Again, in my opinion, everyone's different, and this has to be right for you. But you wouldn't have been doing that if it wasn't for those early years, would you?
I learned very early in finance how to borrow money, and I knew what banks looked for. So
Yeah.
I knew if I had a large home loan, I was pretty much capped out and couldn't borrow any money to do any developments. Whereas I went the other way and sacrificed living with my mother-in-law to be able to then borrow to invest my money and buy development sites and develop them. So that's where I sort of saw the opportunity to be able to understand how to borrow money, to be able to buy properties and invest and develop them and add value. So whereas if I had a house and had a large mortgage, I would probably just been paying that mortgage off. And that's
Would have
it.
been trapped.
Yep.
Or it still would have been a lovely house, but, as far as moving forward financially.
Correct. Yeah.
Yeah. All right. Well, let's talk about the last two scenarios. This is the one that got me the most because I love this one. We've got 2 names now, but we need to think up of 2. Let's just say, what do we got? Tom and Bob. Can this one be, let's chuck a few ladies in the mix here. Can this be Terry and Kerry? Done. Okay. So Terry and Kerry, couple of sisters, they live together. Yep. Actually, no. They live together in a rental property first. So they're paying $500 a week rent, just like the other guys.
Yep.
But they're on a lower income. So they're really starting out maybe early 20s. Yep. Tell me a little bit more about Terry and Kerry's situation.
So a scenario that I'm getting more and more siblings or friends wanting to buy property together because they might be limited on their deposit, they're limited on their income to get into the property market by themselves, and they both want to get into the property market, but together they can do more.
Joining forces, yep. And
they've got a common goal, which is adding value to their property and increasing their wealth, I suppose.
Okay.
So there's ways you can structure loans to reduce your liability. So let's just say the 2 siblings are buying a property together. Rather than being joint borrowers on the total loan, you can set it up so they're only borrowing their portion of the loan. So say 50% of the loan is theirs and 50% of the loan is the other person's.
Talk to me about the benefits of that because I hear people doing this all the time, but I never see the details behind the scenes the way you do.
So the benefit of that is, let's just say you've got 2 siblings buying an investment property together. They've split their loan into 2. One decides to get married in 3 years' time.
Yep.
Rather than have that 100% of that liability against their name, so because they've bought a property together, they're liable for the 100% normally.
Yeah.
They're only liable for that 50%.
Okay.
So what that does is increases their borrowing capacity independently for that next property.
Gotcha. Because
So
if they did it all together completely,
Yep.
then even though they're not responsible for 100% of the loan, in the bank's eyes, get married later, then 100% of that loan would be taken into consideration.
Correct, yep. So by splitting it from the start and setting up properly from the start, they're reducing their liability in the future.
Very clever.
So it's basically called a property share scenario.
Property share. And do you have to do any kind of a company or a trust or anything?
Nothing. No, it can be individual names. Yep.
Cool.
So it's becoming more and more popular, and I think it's I think I recommend it because it just gets you into the property market sooner. And as you know, the sooner you can get into the property market, the more you're going to benefit, especially with property prices going up every year.
And so what do Terry and Kerry need to be earning for them to get $1 million? And for I think their situation, still 88% lend, LMI, and they're in Queensland, but they're looking at a 6% yield. So still a high yield,
Yep.
but we're not swinging for the fence for 7.5. What do the incomes need to be?
Well, first of all, we're going for $1 million worth of properties again. So again, we're going either 2 500s or 330, 330 and 340. Yield at 6%. Deposit required around 162,000.
So our deposits are all pretty similar.
Correct. Yep.
Yep.
So in total, that's for three. Yep. So about $162,000 deposit to 165, depending on the split of properties, because
Of course.
Stamp duty changes depending on the value of the property.
Makes sense.
So in this situation, they're renting, paying $500 a week rent. They can borrow around that $890. Their income needs to be $65,000 a year each.
65 grand. And this is renting, so we're not living with mum and dad or anything like that.
Correct.
So 2 friends, 2 siblings on 65K.
Correct.
So 65 grand a year. I'm not going to get into if that's a lot of money, a little money, but let's look at this now. It's 2024 at the time of recording. You probably would be hard pressed to find a full-time job that was much less than that. Like right now, I think the average income is 89, 90, technically.
Yep.
So 65 grand a year, it's a pretty achievable figure to shoot for.
Definitely. Yep.
Yeah. So if we've got 2 people on 65 grand a year, but maybe you are listening to this going, yeah, I understand it's achievable, but Todd, I'm 18, I'm not on 65 yet, or even I'm 30, I'm not on 65. It doesn't matter what age you are. What changes if all of a sudden they do go into living at home or they go into boarding?
Yep. So if they went back to boarding or living with parents, their income required would drop down to $55,000 a year each to be able to still borrow enough to buy 3 properties.
So it's not enough. So it's not the same amount. Like beforehand, we were dropping from like 140 to 100. So now it's dropping by 10. Why is that?
Because the scenario was that they were renting together in one house, 2 friends living in one, so paying $250 a week each.
And is it also just because the bank look at it as like, even if you dropped from 40 grand to 20 grand, it's like there's a certain amount that you're going to be spending on living expenses?
Correct. So as your income goes up, your HEMS index, which is what the banks use to calculate what you should be spending as a person on that income, would increase too. So on 60 grand a year, your living expenses, according to the bank, should be less as opposed to what they would be if you were earning $100,000 a year.
Just for anyone wondering, HEM's got nothing to do with sewing up your pants. It's household expenditure measure. That's right, isn't it?
Correct, yep.
Yeah, so basically it's what the banks look at as far as your general outgoings are going to be. Even if you're like super saver mode, they're still going to take into account your HEM based on what your wage is.
Okay.
So out of our 3 scenarios, Terry and Kerry, I'm looking at this from lower income earner. If I could kind of rewind the clock 10 years plus and go, all right, starting again, and I'm looking for a mate. If I don't have that much money behind me, I don't have a huge income, but I've saved a bit of cash, I've got 60, 70 grand, or in this case, what would it be, 80-ish each, you could still potentially build literally $1 million portfolio with a friend if you're on anywhere between $55,000 a year and $65,000 a year.
Correct.
I'm just finding this hard to get my head around because the narrative that I personally hate in this society right now is Gen Z and millennials are screwed and baby boomers have taken everything and there's nothing left for you. Just sit down and accept defeat. It's just not true. Like it's such, I hate the whole victim mentality. And I believe that if you really continuously tell someone they're a victim, they'll start believing it and they'll start making choices based on that.
Yep.
Looking at this is pure numbers. This isn't John's opinion. This isn't my opinion. This is actually what the banks would look at in a situation like this. And again, your situation might have different variables to it. You've got to check this out for yourself. But at least loosely looking at this, of 55 grand a year at an absolute base, it's possible. You're not screwed if that's your situation. If you're looking down more so Bob the Builder's route, Can he fix it? Yes, he can. He can fix his portfolio and he can build potentially a $1 million portfolio starting now in 2024 with a savings level of 162 grand and pay, what was that again? 83,000 if he went into full sacrifice mode. So again, if you don't want to go into full sacrifice mode, 120,000. Like we're not talking hundreds and hundreds of thousands. These are still very reasonable incomes, don't get me wrong, but it's not something that's just out of this world. And I think this is one of the big reasons I wanted to make this, John, because these numbers are big, but they're not insane. And just in case if someone's looking at this going, there's no way I got 160 grand in savings. Cool. Don't start with $1 million. Property. Yeah. Like buy a $500,000 property. Yeah. Buy a $400,000 property. They exist. They're out there.
Yeah. So if you don't have that large deposit of $160,000, work out what you do have, and then speak to your finance broker and work out what you can borrow and what you can afford, because like we always say, Todd, like the sooner you can get into the property market, the better off you're going to be in the long term. So there's always going to be capital growth. I've never heard anyone say, I shouldn't have bought that property. So the sooner you get into the property market, the more capital growth you can have. Worst case scenario, if you want to go your separate ways with your friend, you sell that property, you liquidate, you pay a bit of tax and you move on, you make some money. So you're not going to lose. So the sooner you can buy a property with somebody, with a friend, sibling, the better off you're going to be in the long term.
Yeah, I look at that. I think the only way that you're really going to go bad with that is if you buy it and then 6 weeks later go, oh, I hate you now. Let's sell. Then that's probably a bad situation. But if this is a brother, a sister, or a friend that you've had since primary school, like you know what's going on, there is definitely an element of risk attached to that.
Correct.
But like, let's be honest, like it's better than just sitting on the sidelines.
And I think you just got to discuss exit strategies with them. So if something happens and one of them want to sell, well, the other person's got first option to buy it if they can. If not, you put it on the market. Or you have a minimum period in place, say, okay, let's keep it for a minimum of 2 years so we can get some capital growth and both benefit. So you maybe set a minimum period you're going to keep it for. Hopefully that's long term, but if you just set up a minimum period you're going to keep it for, and what's the process of getting out of it? So do you go open market straight away, or do you get it into two independent valuations done and the other person tries to buy the other person out, or they then put it on the market? So just discussing those things up front, working out how to go about doing it and how to get out of it if you have to.
It's such a better way to do it. If you know what the worst case scenario is, also if it happens, it doesn't feel as bad. But if you don't understand what those exit strategies are, and then if something does change, well, then it's an unnecessary stressor.
Yep. Yeah. I've got a situation now, 2 siblings bought a property 3 years ago together. One of them want to get married and buy a new house with her new partner.
Yep.
They've decided to sell that property. I think they've made 200 grand out of that property. They'll get $100,000 each and move on. The sibling that's not going to be getting married now, she's got now got that money available to go buy something else by herself. And the sibling that's getting married is going to be buying a new property with her partner. So
how good? Yeah,
they've both made money by buying an investment property 4 years ago together, and they did that actually in their early 20s.
It's such a good way. We've got a young lad that's going to be jumping on the show soon, and he actually started by buying his first investment property, going halves with his dad. So it doesn't always have to be brother, sister, correct, friend. Yeah. Like maybe this is something you can actually even do with a parent.
Yep, definitely. Some clients actually buy properties with their children, but don't actually become borrowers. They might have $200,000-$300,000 cash available, buy that property, and let's say it's $600,000 property. The parents put in $300,000. The kids borrow $300,000, but they own 50% of that property. So they're investing their money with their son to get into the property market. So that's an option as well worth considering.
And this is what I mean. There is so many different options. If you're feeling under or overwhelmed with this, you're feeling like I don't know where to start. If you're just looking at the one option in front of you and it's probably not a good one, of course it's going to feel that way.
Yep.
But the whole purpose of this episode, well, there's heaps of. I think I've said the whole purpose, and I've outlined several different purposes. But another purpose of this episode is to show you that there are so many different options.
Correct.
And it doesn't matter what your situation is, because even if we go all the way back to Tom the tradie, 140 grand a year, self-employed, and then all of a sudden his income drops from 140 to 100 if he was to go into sacrifice mode. But again, he doesn't even have to borrow $1 million. If he was on the 140, then that's what he can do. But maybe he's on 70, 80.
So can I just chuck another scenario out there quickly? Let's just say you are earning good money, earning $140,000 a year, and your borrowing capacity is very strong. But you might be limited on your deposit, but you really want to get into the property market. and your parents want to help you out,
Okay.
but they don't necessarily want to give you the cash to do it.
Yeah.
You can potentially use your parents as a security guarantee to purchase that first property as an investor as well. So it's not
You mean like guarantor? Or?
as a guarantor, yeah. So you can use your parents as a guarantor.
Mm-hmm.
So if you're limited on your deposit but you're earning good money and your parents want to help you out, you can purchase your first property as an investment, still living with your parents, with a guarantor loan. So that's something worth considering too to help you get into the property market. So it doesn't necessarily mean that parents have to give you cash to help you buy a property. They can provide you with security.
So they might have an asset that's sitting there, house they bought in the 80s, the 70s, it's all paid off, and basically you're needing 100 grand, 200 grand, whatever it is.
Yep.
And then they can use that as, it's guarantor is always similar, or is it the same thing to like cross-collateralizing?
Very similar. But
Very
instead of you using your property to cross-collateralize, you're using your parents' property and you're limiting their guarantee to that shortfall of what you need. For example, if you've got a 5% deposit, say,
Mm-hmm.
that covers your stamp duty, the bank will lend you 80%
Mm-hmm.
against the property you're buying, you're short 20%.
Mm-hmm.
So the guarantor portion of that loan is 20% of the property value that you're buying. So if it's, say, a $1 million property,
Mm-hmm.
20% is $200,000. Your parents are providing a guarantee for $200,000.
Gotcha.
So
Yep.
it's limited to that figure there. So, and the way property prices have gone over the last 3 years, most parents would be in a position where they've got increased equity
Mm-hmm.
and may be prepared to help out their children get into the property market. Everyone keeps saying, oh, how's our children going to be able to afford a property? And we feel sorry for them. Well, if they can earn good money and afford to be able to service a loan with rental income and living at home, that's a way parents can help their children get into a property by providing a security guarantee. I think it's a total new episode there.
I think I was just about to say, I think there's a whole ton of questions that we could sort of dive into with that. But again, it just highlights there's another option. And that
Correct.
might not be the option for everyone, but it's another option.
Yep.
And the one thing that we didn't actually talk about with this that I'd like to actually wrap things up with, John, is the difference with lenders. So if we go back to Tom at $140K a year, so he could service his $890 or whatever it is. So he got the $1 million. What was, out of interest, you don't have to name the lender, but out of all of the lenders that came up on the panel, what was the lowest amount one of the lenders would have lended him with the same situation?
Yep. So same situation. The lowest was around $650,000 and the highest was $923,000. So the difference in lenders is huge.
It's astronomical.
So, which is, again, as you know, I'm a finance broker. I don't think there's any other way you should get finance, and speaking to a finance broker, because the differences between the banks is huge, and you are limiting your options by just going to one bank.
And the ones that are in the six, because there were several in the sixes, they're not just some weird bank no one's ever heard of.
They're well-known banks. Yep.
Well-known banks.
Yep.
Yeah. Okay. And that's exactly why I wanted to point that out as well, because it can be very deflating if someone's to walk into the doors of the bank, like if Tom the tradie was, and they're like, sorry, man, can only give you 600 grand. And it turns out he can actually get his hands on $1 million pretty much. That's going to change the course
Correct.
of your life and how you're investing.
One simple example.
Yep.
So the example of renting and living with your parents.
Yeah.
If you're living with your parents, some banks, and you're not paying any rent at all, some banks won't include any rent expense at all. Not very many of them. Some banks might include $450 a month as board, and some banks might include $650 a month as board. So so that expense from $0 to $650 per month makes a big difference on how much you can borrow. That's just one example of where there's differences. Other differences are if you're casual, some banks would use 100% of that income. Some banks might only use 48 weeks of that income because they take into consideration holidays. So there's many variables that always come into play. Everyone's situation is different. So there's many variables that come into play when you're looking at your borrowing capacity, and every bank is different, which is why I think that's by speaking to a finance broker, analysing your situation, working out what you can do, giving you the options is essential.
Get a 6-pack of beer, spend a Friday night with them. But mate, you've brought this completely full circle, because that is absolutely the point of this, is to make sure that you are assessing all of your options.
Yep.
Because as we've learned over the past, whatever this is going for 40, 50 minutes, there is so many options. And some of them look terrible. Some of them look amazing. Some of them people might not have even known they had. But if people are willing to go down maybe more of a sacrifice route, options open up. But if you're not, there's still options, and there's still some really good ones. Yep. But again, they change drastically from lender to lender, and every single policy is going to make a difference for each person's personal situation.
Correct.
But John, I wanted to ask an action step, and I feel like this is an action step episode. But what's an action step if someone's been inspired by this and they're like, yeah, all right, I'm going to do something. I want to assess it. They can pull out their headphones and just put into practice right now.
So as an action step, I would say, Todd, would be, first of all, speak to a finance broker.
Yep.
Work out what the minimum deposit you need is to be able to buy a property.
Mm-hmm.
Look at what your borrowing capacity is by yourself. And if you can purchase property by yourself, take that next step and start looking for a property. Look at your options as well of potentially moving back with your parents or boarding. If that isn't possible, then look outside the square a bit and see if there's someone that you can buy a property with. Can you buy a property with one of your siblings? Can you buy a property with a friend? Someone who's got similar position as yourself, and look at ways that you can get into the property market with somebody else.
I'm really feeling like the action step, the flavor of that is assess all your options.
Correct.
But know what they are first.
Yep.
And I actually want to add something to this, and I think that you would echo this, John. I'd be surprised if you disagreed. Two things I always tell people when they're going to talk to a broker is, first question you need to ask is, based on my current situation, which obviously you need all the docs and you need to know what your current situation is, how much can I borrow? Find out exactly where you are, because you need to know where the ground is.
Yep.
Then look at what you want to actually do, because maybe you don't want to borrow $1 million. Maybe you want to borrow $2 million. Doesn't matter. Whatever you actually are aiming for, and then follow that up with, what would I need to show you for you to be able to secure that loan for me? And what that's going to do is that's going to then give you a few things. It's going to give you an income goal, because maybe your income needs to change. More than likely it will. Maybe it's going to give you a savings goal as well, because you're looking at your deposit and you're going to need to know, well, maybe I need 200 grand now instead of 100 grand.
Yep.
Okay, whatever it is. But it's also going to give you some different life goals. Maybe it is worth living at home. Maybe it is worth rooming house with a friend, whatever. Again, doesn't matter, but it gives you a tangible target to go, this is now what I'm aiming for. Because if you don't ask that second question, I think you can be stuck in the situation of, well, my now is going to be my forever. And it doesn't have to be. You can change those, because those three things are in your control. We're in all of our controls.
Yep, correct. So really setting yourself some goals of what you want to achieve is probably the most important part of that. So working out where you want to be and what you need to do to get there, I suppose. And
actually, that's a good point, because if you don't have that one, you can't actually do those two. Yeah.
Yeah.
Yeah. No, that's a good action step. I like that. Probably makes more sense.
Yeah, I think so. Work out where you want to be and what you need to do to get there, I suppose, is probably, and have a broker that can help guide you to be able to achieve your goals.
John, we've arguably arrived at the most important question of the entire show. You've been on the show before. I've asked you this question. Truth be told, I've asked hundreds of people this question now, and I forget your answer before. John Kefalianos, what is your favorite pizza?
At the moment, I reckon it's hot pepperoni I've had it with like a honey chili.
That is becoming a more and more common answer. The honey chili is getting quite popular. Where are you getting it from?
I actually love Pizza Teca at McLaren Vale.
Also a common answer. It's surprisingly a common answer for some people from like Melbourne and Sydney, not just Adelaide locals. Pizza Teca is really gaining a reputation.
No, they're very good pizzas down there.
Absolutely they are. All right, John, well, it's almost lunchtime, and I think it's actually it's past lunchtime, but I think it's time for you and I to go grab a slice now, mate. But are there any final words of wisdom or anything you'd like to leave everyone with today on this topic of borrowing?
Really understand what you can do at the moment and speak to someone to work out what you can do, work out what you want to be able to do, and work out ways on how to get there. So there's different things you can do to get to where you want to get to. For example, classic example was moving back to your parents to be able to borrow more money to get a property. If you can achieve that, it's worth a sacrifice. And don't be scared to make sacrifices.
Love it. John Keff, thank you so much for jumping on the show, mate.
Thanks, Todd.